What's up, YouTube? It's Todd Horst here with Tasty Tracker. This morning was a crazy morning with SPY and most of the tickers that were in really shooting up high. Of course, this doesn't want to. Oh, there we go. Okay. Um, with that, I closed out maybe half a dozen positions in my other account, and PDD did close today at 0.89. So that one was only open for 10 days. See if we can go in over here. Sorry for not having this loaded. Okay, yeah, so if I go to option history, closed this for 89, I opened it for 181, so again, that's right at 50%. The ROI for the collateral I put up is actually 28% though. But yeah, it was only held for 10 days, so I consider that to be a very good trade. Remember, PDD was the one that we got off of our scanner under lead scanner. So I just had a general couple quick remarks on the market. You know, a lot of the comments I'm reading on Twitter and Discord, etc., are that the market is way too high and it shouldn't be this high, especially with all that's going on right now. And obviously, the short explanation is that the stock market is not necessarily the economy or anything like that. Although they will sync up over time, the stock market is more forward-looking. So things were bad, and in some areas and respects, they're getting better. And just that transition from bad to better is enough to make things go up. So you also can't put your ideals and your views on the market. So maybe you think with everything that's happening, it should be X amount, but the market doesn't care about what you think. So instead of, I don't want to say to discredit what you think, but you need to make sure you merge the two aspects, both what you think and what you're actually seeing. If you go off of just one of those, you are more likely to get burned. Where I keep going back to the example where when SPY was just about to cross 300, I thought there's no way it's going to definitely reject that, even if it goes up a little bit higher. I thought it was overbought at that area, and then we went the whole way up to 330 or whatever, 340. The high was whatever it was. And so I was way wrong. And had I just accepted and looked at the chart in front of me, even though I thought it was extended, it didn't get a pullback for a very long time. So you need to use both your logic, but also what you're being told and shown to make your decisions. Other people would say that it can't go any higher because it's so overextended. But that's also not the way it works. From one perspective, you can look at the past year and say, with all of the trade talks keeping the market flat, as soon as there was good news, there was pent-up demand, and it would shoot up. And you can see that demand in bonds and metals, where people are still cautious and they have a lot of money in relatively conservative bets. So if things start looking better, a chart can go extremely overextended and for an extended period of time, even though the technicals are saying that it needs to have a pullback. The technicals are an indication. They're not a steadfast rule, obviously. So you thinking that it can't go any higher doesn't mean anything. It most definitely can and will. But if you're concerned with where things are at, you can obviously proceed with caution. That means keeping more on the sideline, maybe entering slower. So, your normal pace is to enter in 2 positions a day and throttle that back to 1 position every 3 days. So that way you're spreading your allocation out further, and that time horizon then will allow your account to be more robust because they didn't all enter in at the same time. The other thing, obviously, is if you're selling credit spreads, you can choose more conservative. Instead of, I typically do 40% in the money, maybe you want to go 30% or 20% if you're concerned that things aren't going to keep going the pace and direction that they're going. But the entire takeaway from all of this is if you don't have positions on because you are afraid of a turnaround, then you're not going to be able to take advantage of the potential next leg up. So if you're concerned, maybe have half of your account allocated instead of normally you would have 3/4 maybe. Only have half of your account allocated. Then if it does leg up, you still at least grow your account. If it legs down, then you only hit half as much as you normally would be, or something like that. But you get the point. At this point, I'm still fine with where the market's at. I don't think it's anywhere crazy, and I actually like that we're pulling back just a little bit from open. I did think the jump to, that's not right. I did think the jump up this morning was a little bit too aggressive, and so I'm glad we're pulling back. I don't know why Robinhood does that. You have to refresh. But yeah, so it was the whole way up to 315. I thought that was a little crazy to go from 310 to 315. So I'm glad to see us down in the 312 range. I would like it if we closed around 312. It's still fine for my portfolio. I have all of my stuff good down to past 300, so below 300. So yeah, so I don't plan on entering any positions yet today, even though the market's still open. I got $1,000 now, so about 1/3 of my account value sitting on the sidelines. But as soon as we have a down day, which today's Thursday, it's the last day of the week for this week because of the holiday. So I'm guessing maybe next Tuesday or Wednesday I'll be able to enter in some more positions on a down day, unless we have a bloody Monday. So anyway, that's it for today and my spiels. I hope you have a good day, and I'll talk to you next week.